Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. His website, polarfuturesgroup.com. Welcome back to the show, Victor, and Happy New Year.
Well, thank you, Jim, and Happy New Year to you, too.
Going into the new year, taking a look at the various indices that you trade on, interest rates, currencies, commodities. Let's run through some of the specific markets and hear what you have to think about them. We know you trade a lot of currencies. The U.S. dollar was at a 14-year high a year ago. People thought it was going to keep going up. It didn't. What do you think happens now?
Well, let me say that my macro view for a number of years, and my trading has been bullish the U.S. dollar for any number of reasons. But certainly there's a thing about, you go back to the well. I've made some pretty good money being bullish of the U.S. dollar, and I developed a bias. And I'd say, this past year I have been a little puzzled a lot of the time as to why the U.S. dollar was as weak as it was. It fell about 12%, I guess, on a sort of a basket basis over the course of the year. And, sometimes when you have a bias, you can't get out of your own way. My risk management for the trading that I do kept me from losing money by just being stubbornly bullish the U.S. dollar. Actually, when I go to that, I have macro views on what I think about the markets. But then my trading, which is what I do for my own accounts, it's very, very dependent upon what I see in the charts. Let's just say it that way. And I mean, the ideal world is when both my macro view and what I think I see in the charts are in sync. That's like a green light special. But when it's not happening, and I'm asking myself, gosh, what am I missing? It kind of reminds me of, what was his name? Donald Rumsfeld, the defense secretary, was talking about the unknown unknowns. I've seen the euro currency in particular rise this year, and I go, God, I just don't really see that, but, it is what it is, so I just respect it and stand back. I'm going to maintain that my bullish dollar bias, but certainly from a technical point of view, I'm thinking the dollar is at a really critical point right about here. We've just come through the December period, and over the years I've learned, you can't trust what happens in December because the lack of liquidity, the markets are very thin, that sort of thing. But during that period of time, we saw the U.S. dollar really weaken, and that kind of brings us to this critical point. And the U.S. dollar is weak against a lot of currencies. I mean, I look at what we call off-the-run currencies, the Korean won, the Singapore dollar, for instance. And the U.S. dollar is weak against them as well. So right at the moment, trading-wise, I also, back away from the market at Christmas time, so I don't have much in the way on in terms of positions. And I'm looking to get back into the market. Got a bullish dollar bias, but I'm going to need what I see in the charts get in my favor before I put a position on.
The Canadian dollar's been tickling 80 cents U.S. What's your view on that?
Yeah, with Canada, okay, I said I've got a U.S. dollar bullish bias. I watched Canada break out of a trading range that it had been in for a couple of months. We rallied from about 77.5 cents up to 80 cents here right at the end of the year. I use that as an opportunity to buy some puts on the Canadian dollar. Again, I'm bullish the U.S. dollar. I'm looking around. I'm thinking, so what is the what's the weakest animal at the back of the herd, as it were, if I want to take a shot at something. And I thought that Canada was maybe more vulnerable to falling back than maybe the euro or some other currencies. So that's what I think on Canada. Obviously, NAFTA issues are lurking out there. There's another thing too, and that's been how little Canada price action has been correlated to crude the past several months. And the shadow in behind that might be that we see the crude price as WTI, but for the Canadian market selling into the American market, the price really is what we call Western Canada Select. It trades at a discount to WTI. That discount was running around $10 a barrel this summer. It got down to, like $25, $28 discount. So the revenue that we might be getting from exporting crude is much less because that discount's so deep. I'm not all that sure. I'm taking a trade here. It's only a trade. If the Canadian dollar continues to rally, I'll be out of it with a small loss. But right now, I've begun the new year, starting to put positions on, and I own puts on Canada. I'm short calls, I should say.
The Canadian dollar, I know last year, did trade outside of what the oil market was doing. Does that mean that Canada actually is starting to be viewed as more than just a place where you get oil?
Yeah, I think I remember back when I was in school, back before they had color television, that we used to call Canada the hewers of wood and the drawers of water and all that. I think the thing is that Canada this year, certainly the second half of the year, was way more driven by the interest rate spreads between Canada and the United States than, let's say, marching in correlation with the ups or downs of crude. You remember, when was it? Seems like it was the 5th of May, I think, we made the low for the year in Canada. And then in early June, some senior people from the Bank of Canada came out and, in their own language announced, we've had a change of heart. And the message was that we were going to start seeing the Bank of Canada raise interest rates. Well, that seemed to just catch the market flat-footed, and that sort of accelerated this move in Canadian dollar. We went to just a very dramatic change in the premiums of the United States interest rates over Canadian dollar rates, and that was the main driver. That's backed off a bit here, I think, the last few weeks, but yeah, we certainly are, in the broad scheme of things, still a commodity currency, like the Australian dollar is, but this year, for some reason or other, we lost that tied to crude oil tendency that it's had in the past.
We'll have more with Victor Adair right after the break.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan District of northwestern BC. Check us out at blindcreekresources.com.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Welcome back. We're speaking with Victor Adair. Victor, many people say that the gold market is a mirror image of the U.S. dollar. What do you see ahead for gold?
Well, I think those people are right. Over big chunks of time, the negative correlation or inverse correlation between the U.S. dollar and gold is very strong. There's another factor, and that's what real interest rates are. So if you had an environment where real interest rates are rising and the U.S. dollar is rising, and you wanted to make a bet about whether gold was going up or going down in that environment, chances are it's going down. So what I said earlier, I've got this bullish U.S. dollar bias, although I kind of think we're at a critical point here that the U.S. dollar, if it's going to find some footing, it's got to find it pretty soon here. We've had the gold market pop about $80 since the middle of December, which has been a pretty dramatic move. Now, that happened while the U.S. dollar was weakening, as I said earlier, in this thin volume period that we have around Christmas time. But interestingly enough, during that same period of time, real interest rates were rising. And I thought, gosh, that's interesting that gold, it's really following the U.S. dollar weakness and ignoring the rising real rates. So we've had this move. My son, Drew, trades some managed accounts, and in one of the managed accounts that he has is one that I've funded for him. And this morning, he bought some puts on the gold market, just thinking that running $80 here in the course of 2 weeks was too much too fast. And, we're making a bet here that the price may back up a little bit. I don't mean fall to zero, but, if the gold price is backed up $30, $40, $50 or something, that'd be quite a move for us.
Global stock markets have been rising for several years, and we saw all-time highs in several of the indexes last year. Do you think the stock market is just going to keep climbing higher this year?
Well, I think that's the bet you have to make. I mean, there is an incredible tailwind that's been pushing the stock market higher. And that has to do with central banks, but, maybe we can get into that later. Yeah, I mean, gee whiz. I mean, the people have been trained, to just buy any and every dip in the stock market. It's been a heck of a move to the upside. We haven't had, I think, as much as a 3% correction in the major American benchmarks in 15 months or so. Volatility is at historical low levels, like complacency. Nobody's worried about anything. Passive investing has been huge. Of course, the increase in volumes on ETFs has been mind-boggling. It seems to me, that the market would be overdue for some sort of a break. But just to say, gee, this market, like again today, made new all-time highs. Should I go out and short it? Absolutely not. The trend here is so powerful. It looks like it's going up, and then I pay attention to Martin Armstrong. I have for years, and Marty's talking about much higher prices, but, and I noticed this in his latest service that I subscribe to, but he's looking for a lot of volatility this year compared to what we've seen last year. So I don't think you just buy stocks and go to sleep. I think you got to pay attention.
Now, we've had central banks around the world adding a lot of liquidity to the markets. They're now reducing those programs. Japan's even doing it very quietly, but still doing it. So do you think if the central banks get out of buying stocks, prices will still keep going up?
I have seen the charts. They're out there, the correlation charts, where you plot the rise of the major American benchmark on top of the rise of the amount of liquidity that the central banks have put into the market. And, depending on how you scale the charts, you can make them look like they're virtually identical. And, obviously, there's been trillions of dollars worth of liquidity in different currencies put into the market by the central banks around the world. It had to go somewhere. And, of course it's gone into the stock market. It's also gone into the real estate market. It's also gone into the bond market. And here, what year are we in now? We're just in 18, but in the summer of 16, we had interest rates at 5,000-year lows. You had whatever it was, $12 trillion worth of sovereign bonds trading with negative yields. It's a through the looking glass kind of world here with what the central banks have done. But the stock markets have been marching higher. If, and it's a great question, if what has helped take the markets higher is taken away, wouldn't the markets fall? You go, you can see that. I think the markets have been trained to believe that the Fed has their back. Now we're going to have let's call it a whole new Fed. There's going to be a lot of new faces at the FOMC as we go through this year. the Fed is aware that their activities have caused this inflation in asset prices. You know, it's possible that the Fed might even be concerned that what they have done has contributed to income inequality in America. Oh my God, you know, what a horrible crime to be guilty of. Financial conditions are extremely easy. So, the chances of them raising rates, sort of taking away the punch bowl, as it were, seems to me to be, I mean, that's what they say they're going to do it. I think they will. And yeah, I think that would be one of those things that could cause some shivers in the stock market, and some other factors as well. But yeah, to answer your question, yeah, I think when they take the punch bowl away, it kind of quiets down the party.
We'll have more with Victor Adair right after this.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're chatting with Victor Adair. Victor, the central banks have been pushing ultra-low interest rates for the past several years. Are we going to see rising interest rates this year?
Yeah, I think so. Again, I told you that Drew manages some money for me and some other people as well. And in the account that he manages there, and I mean, Drew and I talk every day about what we're doing. But we own puts on the 10-year Treasury bond, and that's a bet that interest rates will go higher. So we're putting our money where our mouth is there.
What effect will that have on the markets?
When you say what effect will that have on the market, if the Fed is, if they are pushing up interest rates, well, interest rates go higher. So we're making a bet by being short Treasury notes. We're making a bet that the prices of the Treasury notes will fall as interest rates rise. I mean, the long end of the market has not been, the yields there have not been rising anywhere near as much as the short end. I mean, you got the 2-year Treasury is at about a 9-year high yield. So we've had this incredible flattening of the curve as short-term rates are rising faster than longer-term rates. But we think that'll catch up. Actually, it'll be contagious, perhaps, with the different markets around the world, the rising interest rates.
Well, Europe went to negative interest rates. Japan had them. Was that a failed experiment?
Yeah, well, that's a really open-ended question. We had negative interest rates. There are still negative interest rates in places. It is what it is. As you know, as a trader, that's what you got to look at things. You know, rather than should it be something else. I think they are collectively backing away from that kind of policy. Maybe it's even a case of, gosh, they got to get interest rates higher so that if in fact we go into a recession again, you know, they can have some lowering of rates, or maybe they'll have to pull a different kind of rabbit out of the hat.
Well, I mean, for 5,000 years, we never had negative interest rates. You'd think we would have used them in that period at some point if we thought they were a good idea. And I couldn't see why would I put 10 grand into a bond that's going to pay me, you know, $9,500 at the end of it. Yeah. Well,
I didn't see the sense in doing that either, and I didn't. But negative interest rates were an Alice through the looking glass environment. That, and I think that's changing. I think we're going to higher interest rates.
In previous interviews, you frequently talked about crude. We see that WTI prices were above $60, a 3-year high. Are you trading crude?
At the moment I do not. I haven't really done much in crude for the past few months, and I'll tell you again, just sort of like my bias on the U.S. dollar, I've made some pretty good money the past 3 years or so trading crude almost always from the short side. You know, as prices fell from at one point about 110 down to as low as below $30, and there's been some cycles in there, and I've generally traded it from the short side. This year, I mean, from June through to where we are right now, prices have risen on the front month WTI contract from about $42 to $62. That's nearly a 50% increase. And Mr. Stuck with his bias here, I haven't been bullish. I haven't bought it. The good news is that my sort of risk management kind of techniques that I use has kept me from losing my shirt in there by, being short. So it's been a case of almost like one thing after the other. The OPEC and the allies, as I like to say, renewed their production cutback agreement. We've had, a pipeline here, a pipeline there go down, and supply-demand ratios seem to be tighter. There has been a massive increase in bullish psychology in the market. And today, it seems in some parts that the rally is being attributed to the social unrest, there's a polite term, of what's happening in Iran. Maybe there will be a disruption of Iran's ability to export crude, and that's bullish. I tell you what, I'd say that if being up $1.25 or so today was because the market thinks that they're going to stop pumping oil out of Iran, I would fade that, but this is a market that's trading at a 3-year high. I got to be pretty arrogant to want to go out and short it. So I'll just watch, and if it looks like it's running out of steam, I might get short. But right at the moment, I have no position.
Well, Rick Ackerman told me he wouldn't be surprised if it dropped down to $30 again.
Yeah, well, I could see that. Here's the thing with trading. I think everybody that is trading wants to get at least one really hero move. The crude's at $60. You go in, you get it short, and the stuff collapses to $30, and you add to your position along the way and become rich and famous. Wouldn't that be great? But what trading really is to me is grind it out. I'll take a position on a market because I see an opportunity. If it turns out that trade becomes a really profitable trade for me, that's just because, I got into it using my normal kind of techniques, but it kept going, and somehow or other I had the patience to stay with it. As opposed to, I saw it coming, jumped on it, took advantage of it. It's more likely the first case.
What other trading opportunities are you watching?
Oh boy, well, a bunch. I'll tell you one thing that kind of puzzles me, and that is how low German interest rates are. The economy is red hot, and they got negative interest rates. So maybe I ought to be short German bonds. But then when I think, okay, I could be short German bonds, but I'll tell you what, if the German bond market's going to back up, then that'll kind of by osmosis get into the other bond markets like the 10-year treasuries where we're already short. Here's something that's not so much a market thing, but it would be what didn't happen this year. For instance, this year past, geopolitical risk didn't seem to matter. There was all kinds of things going on. You don't know if the FBI is going to take Trump out of office, or if Germany or Italy or France or Spain, Catalonia, Brexit, all this stuff. Market just kind of chugged merrily along to the upside. I just kind of wonder if maybe we'll have some sort of a geopolitical scare in the market this year that'll cause things to move. For your audience in particular, look at this. The commodity stock ratio is at a 50-year low, a real extreme. In other words, commodities are dirt cheap compared to the broad stock market indices. Or say it another way, commodity purchasing power is lousy if you want to go out and buy stocks. Some of the agricultural markets are really low. And then, here's another one too. We had a brutal bear market in commodities from, let's say, 2012. We made a low in a lot of markets right in January of 2016. Commodities have been rising a bit in the last year and a half, but not nearly as much as stocks. You know, maybe we're getting a turn in the commodities to the upside. And my good friend Peter Brandt, who I talked to a lot, he's looking at the multi-year charts on gold, and he's got me interested in this too. You know, this is not typically my kind of trade where I'm going to put on a trade because of what I see in charts going back over a few years, but we could be shaping up that we're making a major bottom in gold, and that would kind of tie in with some of these other things I mentioned about, you know, the German interest rates being so low, political risk, commodities low, all that sort of thing. So, yeah, that's another one I'm looking at.
Would one of the reasons why geopolitical risk didn't matter so much is that markets are so diversified and people are spread out across the planet. One little blip in one little place really shouldn't upset the apple cart that much.
Yeah, well, yeah, that could be. And I don't discount that. That's a good idea, Jim. But what I think I see is there's just so much complacency in the market, you know, and you get trained. When the market just keeps chugging along, and any time for any reason it has a little dip, you are rewarded to just step up and buy that dip. That just reinforces that complacency. So we haven't had our bell rung in a while. So maybe something will come along and do that.
Victor, so much for chatting with us.
Well, Jim, good to talk to you. Thank you kindly for calling.
My guest has been Victor Adair, co-founder of the Polar Futures Group. His website, polarfuturesgroup.com. You're listening to HowStreet.com radio. If you have any questions for us or our guests, they can be emailed to info@HowStreet.com. I'm Jim Goddard. Have a great Happy New Year, everybody.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.